It's January 24, 2009. This is Maximize Utility. I want to finish Macroeconomics 2009. This will be part 2 of 2. And I want to finish up fiscal policy. This time we'll talk about government spending. That's the big G and Y equals C plus I plus G. And then I'll do some highlights out of monetary policy. Way too extensive an area to do it in great detail. But I'll try to hit some of the high points. And then I'll give you what I call the microeconomic solution, or the maximize utility solution. Instead of all these phony macroeconomic solutions, let's find out what we can really do to solve the problems of a recession. Fiscal policy by spending. Spending is the G in the equation Y equals C plus I plus G plus NX. Y is GDP. In the right side, those four quantities, is aggregate demand. This is the demand story of the economy. NX, by the way, is net exports. That's exports minus imports. So if you go out and spend your money on gas, which is imported, or stuff from China, which is imported, you're not helping our GDP. Now, people are not doing enough C, supposedly, even given tax cuts. So the government has to go out and do direct spending. Now, this is extra spending. This isn't the regular government spending. And the Obama administration is proposing about $850 billion of this extra spending. And this is a number off the scales by historic standards. Now, we're already in a deficit position. The government's already spending more than it takes in anyway. For example, the spending we do in the Iraq War, an extra amount of about $100 billion a year, that is, in a sense, a Keynesian stimulus. But nobody ever talks about that as a Keynesian stimulus. That would be very impolite in certain circles. Now, the government spending is supposed to create a multiplier effect. Basically, you get the spending for free, and then you get some more spending after that. That's the basic Keynesian story. But other people say that it doesn't create any such multiplier, that it just displaces other spending. They say the multiplier is zero. I happen to think that's valid, but this is where sides break. The people working for the Obama administration think that the spending does create a multiplier. Where does the money come from? Again, we don't really ask this question. We borrow it by selling U.S. treasuries, and we just think it will be forthcoming. Now, another problem is a timing problem. The economy has been in a recession since December 2007. It's already a long recession, but it looks like it's going to go on. But the government spending has to hit in the recession or before the recession's over. Otherwise, it will just exacerbate an improvement in the economy. And the projects that we're supposedly going to spend the money on are supposed to be shovel-ready, is the phrase. So what are we going to spend the money on? Supposedly, they're projects that will pass some kind of cost-benefit analysis. But we haven't started this process yesterday. We've been doing government spending for a long time, and haven't we already pretty much settled on what projects are legitimate by government? So economists will tell you that you're going to end up doing a lot of misallocation, and you're going to end up finding a lot of bottlenecks where you're going to start spending on things that you really don't have the resources to build at the time, and it's going to be very costly. Now, let's say it all does work to some extent. It will supposedly forestall some recession. Instead of having a recession the last 3 years or the last 2 years, or instead of the recession being negative 6% of GDP growth in 1 year, it will be only negative 3%. But these few percents of GDP on a $14 trillion GDP, how much will they add up to? Because we will have to pay it back. Now, some people say, no, we don't have to pay it back, that it will pay for itself because the GDP will grow so much faster, so much quicker. But that is very dubious. Now, if you look at the case of Japan, they did a lot of fiscal spending, and after years and years of doing it, all they ended up with was increased debt. Monetary policy and related financial market intervention by the U.S. government. Monetary policy, up until about 2008, was very simple. As I taught it semester after semester after semester, it was all about the Fed doing open market operations, that is, buying and selling treasury bonds to private banks, so that the Fed could control the Fed funds rate. And the Fed funds rate is the rate that banks lend to each other overnight at. And then there was a story about that rate would then transmit to the economy. And here's a picture of what's called the transmission mechanism. It's just one of many pictures, and different diagrams of this mechanism have different things. But this one's pretty typical. At the top you see the open market operations. They will affect the reserves of banks, and then so on. It will affect the Fed funds rate and the so-called monetary base, and then the greater money supply and market interest rates. And then you see it bubbles through in various what we call channels. There's actually 6 channels in this diagram: the narrow credit, broad credit, wealth, interest rate, exchange rate, and monetary channel. And then it hits the real economy. Y equals C plus I plus G. C plus I plus G, that's aggregate demand. That's what you see at the bottom there. So the idea is that the Fed can change the rate through open market operations and then can affect the real economy with some lag. That's the way we did monetary policy for about 20 years. It was very gradual generally, and it was very, I call it tweak-like. It was little changes, gradual changes, raising the Fed funds target rate by 25 basis points 15 times in a row. And it was strict. We didn't dabble in other things like bailing out investment banks. And it was, in a way, aloof. The Fed was independent. It was independent of the U.S. Treasury, and it was independent of Wall Street. And it was also supposed to be revealing. As Alan Greenspan went through his term and then Ben Bernanke came on, the Fed would be telling private parties more and more and more about what they were doing, how they were forecasting. And I say the emphasis at this time was on keeping inflation low. The idea was you were not supposed to make any hint whatsoever that you were putting more money out there than the economy could handle. Now, Alan Greenspan supposedly did it with mastery in his 20-odd years as Fed chairman up to about 2005. Did it work? Well, it kind of looked like it worked. It's easy to falsify that the things he did worked. Now, Ben Bernanke came in, and he was originally somewhat of a hardliner. He was an inflation targeter. And I contend that 2000 year was the year of inflation targeting. If you dump a lot of clips from the press, you'll see that everybody's talking about inflation is the problem, and the central bankers were worried about inflation. Now, what happened? 2007 gave us the first murmurs of big problems in the financial system. It was the housing market that started to fall apart. It was initially the subprime market. And there were events like in the summer of 2007, two big hedge funds run by Bear Stearns went broke. They couldn't price the stuff they had in the fund, some kind of mortgage-backed securities. But still in 2007, we were somewhat confident that the economy was okay. Economists were still predicting that the economy would be okay. A lot of them in 2008, and Ben Bernanke was still more worried about inflation and was averse to lower rates. Anyway, 2008, it became obvious that recession was the bigger problem, and even perhaps deflation might be a problem, and we started to change our tune, and the Fed went hog wild. It decided it would save the entire economy, that a decade of bad contracts and too much leverage would be rectified by the Fed, all to save the economy, to save our GDP growth. And one thing was, Ben Bernanke was a great student of monetary policy history, in particular depression. In the Depression, we did bad policy. We were tentative, and we reversed policies and did contractionary policies. And Ben Bernanke was going to learn by that mistake. It's basically that his mantra was something like, do it fast, do it certain, do it big, and do it hard. It has to work. Now, that may or may not follow. Anyway, the Fed started buying out all kinds of debt in all kinds of entities and expanding its purview into all kinds of securities. It started with buying out Bear Stearns in March of 2008, and then the Fed supported and or bought out other companies, AIG and Fannie Mae and Freddie Mac and certain big banks. Fed started getting involved in the commercial paper market and started lending to investment banks. And here, the Fed's balance sheet grew from having about almost $1 trillion of U.S. Treasuries to drawing that down to a few $100 billion, and then having well over $1 trillion to $1.5 trillion of other stuff. And all along, Ben Bernanke would say the Fed had more and more tools in its toolbox, meaning it could buy more and more different things. And it gets really wild and really weird. Everybody was trying to find the sweet spot. How could we change the lending behavior of institutions to get them to lend again, something like that. And the next big piece was the U.S. Treasury and the so-called TOP, a $700 billion fund to buy out what were called toxic assets of financial institutions. They couldn't figure out how to implement the program. They really didn't know what to do with it. Where did this $700 billion number come from? It was really a rough estimate. Some people said it had to be more than $100 billion. It couldn't be $4 trillion, so they picked a number in between. The top money eventually got given to certain banks, and in return the U.S. government got preferred stocks and warrants. Some people said it didn't work, that the banks were just using the money for operating purposes and for keeping dividends and paying executives. Other people said the banks were hoarding the money. Some people said that was bad. Some people said that was good. That's what banks should do, so they can true up their capital structure and then make loans on other money that they get as deposits. Anyway, as I said, it got weird. Experts were trying to find the answer. Is there an answer? And, for example, one guy comes along, he says, well, what you got to do is get the price of houses up. So he said, go renegotiate all the underwater mortgages out there. He said that this would only cost the U.S. government $380 billion. Another guy said, well, get rid of the supply, bulldoze 1 million houses. Another person had a solution, bring rich foreigners in, offer them U.S. citizenship, but they promised to buy property. Anyway, all along there was this idea that there was a solution so long as we tried to do it.